Okay, now just tell me once more, is the screen visible?
Yes, ma'am.
I'll be asking this question frequently. Is it visible?
Yes, ma'am.
Yes, sir.
Okay, okay, fine. Okay, so now we shall be moving on to the income statement or the profit and loss account. So as I have mentioned earlier, I shall be talking in terms of two financial statements, two publicly available statements. One is the balance sheet and the second one is the income statement of the profit and loss. So in the last session, we found out that there is a basic identity on which the balance sheet is rested. And for the income statement, we have a similar identity. So what is that identity? It is based on the identity that profit is identically equal to all kinds of revenue minus the expenses. So if you have revenue from your sales operation or the operation or any other activities, then from that, if you subtract all types of costs, then you are coming to the profit. So this is the income statement of a firm. So once again, it will be available on an annual basis, but at the same time, you can have quarterly data also, and you can have 6 months data also. Now, why is this important to have a quarterly data or a 6 month biannual data? Now, when we are working with some empirical data, and if we work with the empirical, if you work with the annual data, then the problem is that when we do some research in the context of financial economics or financial market, we are basically interested in the variability. In some other cases, we just say that, okay, variability is not a good thing, therefore we subtract or we try to filter all kinds of variability from our data so that we work with a filtered series. But in the context of the financial market research, it is the variability that bothers us. Why? Because if the market is variable or vulnerable, or if there is a volatility spillover, the rational investors, of course, will not be interested in that. And if I am a speculator, I'll always be interested in the variability because I will be making some profit out of that variability. I can design suitable trading strategies. I am not considering trading strategies here, but we can design profitable trading strategies on the basis of the variability. So there are different types of traders in the market. So usually the balance sheet and the income statement will be available on the basis of, or rather it will be available on an annual basis. So it might be difficult to work with that data. Now, if you are doing some empirical exercise, the size of data is really very much important. So if you just take 10 years of data and you jump to a conclusion, then that is not a good thing to do, you know. So in order to conclude, we should have more data. And if you are talking in terms of the annual data, then it is difficult to get this fundamental balance sheet or the income statement data in a more regular frequency. So that is why there is a problem. So we can go for the quarterly data also in order to get a better result. Okay. So now move on to the income statement. So from the income statement, we first report the total operating. Yes. Is it not visible?
No, I think someone is trying to enter. Could you please?
Okay, someone is trying to enter. Okay. Okay, so we start from the total operating revenue. So this is the revenue that we get, or that the firm gets actually from its operation. So this is the sales revenue. Maybe if the firm is selling the commodity, so it is the sales revenue. So we start from that. So out of that, now we shall be subtracting different types of costs and the expenses in order to come to the profit. So first of all, we shall be subtracting the cost of goods sold. Now, here we have made a distinction between goods that are being sold in the market and goods that are being left in the inventories. So there may be inventory accumulation, so that if there is not enough demand, there will be inventory accumulation, and if the demand increases, then inventory may be decumulated, right? And in the last session, I have also discussed about how the inventories may be treated as an instrument, or maybe taken as an instrument to restrict other firms to enter into the field. So this cost of goods sold will be the cost of producing those goods that are coming back to the market actually for sales, right? Then we are considering all the other types of costs in the other category. So all kinds of selling, general, and the administrative costs. So everything will be coming under this category. So this selling cost is not the same thing as the cost of goods sold. So this is the cost of producing the goods that are coming to the market for sales, and these are the selling costs that are related to the sales activities. Okay, so you will have to make a distinction between these two. And then comes another important type of cost, which is the depreciation. So depreciation, as I have mentioned earlier in the context of the balance sheet, each and every fixed asset will be having its wear and tear. So we have to have some money to replace our worn out machines. So that will be done on an annual basis. There are different methods of calculating that depreciation. Now, once again, being a researcher in the field of financial economics, I am not going into the details of calculating the depreciation, right? So there are different methods for calculating depreciation. So we are just assuming that there will be depreciation. There are different ways of calculating it, and it will be treated as a cost for the firm. So right now we are at a position to define the operating income. So what is the operating income then? So it is different from the total operating revenue. So what is the operating income then? It is the total operating revenue 1 minus cost of goods sold minus 2 minus 3 and minus 4. So that gives us the operating income. So this is the income that is originating from the sales of the commodity in the market. Now the firm may have some other activities also. It may have some other income. It may have other, say, some interest bearing assets or income bearing assets. So in that case, income will be generated from that sources also. It is just like a salaried person. For example, a salaried person will be having his or her salary plus some other income coming from the other sources, say bank interest, capital gains, and something like that. So when the income tax is calculated, so the salary as well as other incomes will be added on to find out the taxable income. So exactly the same thing will be done in the context of the firms. So now we calculate the earning before interest and taxes. So this is a very important concept for the firm, and that will be used later on in defining the different ratios. So that is abbreviated as EBIT. As the name suggests, it is the earning that is calculated before the interest and the taxes are paid by the firm. Okay. So how is that calculated? That is the total operating income plus other income. So that EBIT already excludes different amount of costs. Now, say in the earlier session, we were talking about the conflict of interest between the owner and the manager, right? So what we talked about is the manager will be interested in maximizing the sales or the operating revenue, whereas the profit will be the most important thing for the shareholder or the owner of the firm. So in that case, since there are so many items there, so the sales maximization may not be equal to or equivalent to the profit maximization. So from here you can easily identify where there should be a conflict of interest. First of all, that is the first line of conflict, and of course you can find out the other line of conflict of interest from here also. Okay. Now, from the EBIT to arrive at the net income or profit after tax, we first deduct the interest expenses. So that is one of the advantage of going for a debt financing, because interest payments are exempted from the taxes, right? So if the firm goes for debt financing, of course the vulnerability of the firm will be increasing, because the interest payment is an obligation. Therefore, if the firm cannot pay the interest, it will be bankrupt. So this bankruptcy may be complete or it may be partial. So in case of complete bankruptcy, this interest expense will be zero. Why? Because there will be no EBIT to pay this interest expense, right? And if you just go through the income statement of the real life income statement of the different companies, then you will find that in some cases actually the EBIT becomes zero or negative. Now, EBIT cannot be negative, of course, in real life, but in accounting sense, once again, EBIT may be negative. So we shall be treating that as zero, of course. So these interests are tax free. Therefore, the interests are first paid. And then we calculate the taxable income. So that is called the earning before taxes, EBT. So EBT is calculated as EBIT minus all kinds of interest expenses. So this is the amount on which the firms will be taxed. So higher the interest expenses, higher will be the vulnerability, of course, and lower will, or rather, the higher will be the interest tax exemption from interest. So debts will be having its advantages as well as disadvantages. So now there will be taxes, the corporate tax on the firm. Now recently there has been a decline on the corporate taxes, and it has not been similar for the new firms and the old firms. And one research paper, maybe, in fact we are, me and my supervisor, PhD supervisor, are now actually interested in this type of analysis, that after this tax exemption, there will be some money in the firms. So where did that money go? What the firms are doing with that money? So that may be an interesting observation or an interesting area to explore. Okay, so after that, taxes will be imposed on the firm. Now, as we discussed earlier, the taxes may be deferred or the taxes may be current. So in the income statement, we just try to find out how much tax is paid as current tax and how much tax is paid as the deferred tax, right? So the firms can defer the taxes. Okay. So now we come to the net income or PAT or the net profit. So this net profit is the earning before interest and earning before taxes minus all kinds of taxes that the firm has paid. So it is basically 9 minus 10 in this table. So this net profit is very important for the firm. So this is the amount which is actually available to the firms for paying the dividend, or it will be retained as a fund which will be used for further investment opportunity. So here this net profit can be either paid as dividend or it can be retained. Now, so this dividend and retained earning may come in many different proportions. Dividend may if you consider the dividend payout ratio, dividend as a proportion of the net profit, then this proportion may vary from 0 to 1. If the proportion is 0, then the firm has decided to pay no dividend in this particular financial year. And if it is equal to 1, then the firm is paying out its entire net profit as dividend. Now, we should not jump to any conclusion just by looking at this payout ratio. So paying out a zero dividend so that the payout ratio is zero is not always a sign of weak health of the firm. Similarly, if the dividend payout is equal to 1, that does not necessarily imply that the firm is really in a good condition. So we must concentrate on the retained earning, right? So this retained earning, as I have mentioned, will be available for future investment. Now, if I could just recall our undergraduate macroeconomic theory on investment demand, then we shall find that usually this retained earning is higher for the smaller firm. So that is one way of dealing with the retained earning. But as I have pointed out, there are so many other ways of considering that. Now, why the size is inversely related to the retained earning? The theory of investment demand says that there may be credit rationing, right? Particularly during the period of a crisis, there may be credit rationing. Now, what is meant by credit rationing? The credit rationing simply means that the financial institutions will not be borrowing money to the firms even if they have the capacity to pay it back, right? So it is a problem of identifying, or it is a problem of distinguishing a good firm from a bad firm. So a firm may be a good firm, quote unquote good firm, in the way that it is its creditworthiness is high. So if it is taking a loan, it is going to pay back the loan. And at the other hand, there will be the bad firms, so they will be having lower credit worthiness. So if you just give loan to them, they are not going to pay it back. But the point is, how could you distinguish between these two types of firms? Of course, there will be some credit ratings of the firms, but in a particular period of time, suppose we are considering a particular crisis period, then even the good firms may fail to meet their obligations. So their credit ratings may be high, but they may fail to pay out their loans. So it would be very difficult, or rather, it may be very difficult to distinguish between the good and the bad firms. So there may be a credit rationing. Often,
ম্যাম কেউ একটু ঢুকতে চাইছে, একটু দেখে নিন।
আচ্ছা আচ্ছা দেখছি। ওকে, আচ্ছা কেউ যদি ঢুকতে চায় প্লিজ লেট মি নো, হ্যাঁ, বিকজ আই এম শেয়ারিং দ্য স্ক্রিন। সো আর আমি আমার ওই ফোনটা থেকেও আমি বেরিয়ে গেছি, সো আই জাস্ট কান্ট সি, আমি এটাও পাচ্ছি না, নোটিফিকেশনটাও পাচ্ছি না। সো জাস্ট প্লিজ লেট মি নো ইফ সামওয়ান ইজ ট্রাইং টু এন্টার। ওকে, দুটো জিনিস আমাকে একটুখানি বলবে, একটা হচ্ছে whether the screen is visible or not, and whether someone is trying to enter or not, apart from the questions that you have. Okay, so that means that during the periods of crisis, there may be credit rationing, and this credit rationing is often more binding or more serious for the smaller firms, just because of the fact that they just don't have any significant tangible or intangible collateral to offer. So in this case, intangible collateral will be more important so far as the theory of investment demand goes. Therefore, the small firms, since they are not being able to avail the external financing, so they will be relying more on internal financing and basically on the retained earning, because it is the part of the profit that is not being distributed as dividend. So in one way, if the firm is a small firm, then it is going to have a retained earning. But as an investor, the things are becoming more and more complicated for you. So retained earning is higher, will be having some other implications also. So it gives us some idea about the perceived profit opportunity. Now, when you are thinking of investing in some particular asset, be very, very careful about two things. One is your actual figures and the other is your perception. Now, often the actual things match with the perception, but if that doesn't match, then that is the initiation of a crisis. So I'll be emphasizing this point frequently because that is the main idea of this analysis, entire analysis. Okay, so if the firm is having the retained earning, then as a common investor, what I might think, suppose I just don't know whether the firm is a small firm or whether the firm is a large firm, whether or not it is suffering from a credit rationing. Suppose I don't know anything about the macroeconomics, then uh, and of course I don't know anything about accounting, how the balance sheet is very minutely calculated. So suppose I don't have any other information on that, then retained earning to me will give us some idea about the perceived profit opportunity. So why the firm is retaining earning? The firm is not a very foolish entity, so it is just behaving like any other rational individual, any other natural individual. So it will be having its own strategy, right? So why it should retain earning? Because dividend is always supposed to be, once again, good for the investor. If you pay the dividend, you will be treated as a good firm, so more investors will be attracted into the field. So retained earning from a common investor's point of view is an indicator of the perceived growth opportunity. Why the firm is retaining something? So perhaps it has some strategy, it has some plan to expand in future, and the plan itself is not very important, right? Because it should have the opportunity. Now, if you have interest, you can consider the IT firm's income statement during the period of internet bubble. So that was the period when the IT stocks were riding high. If you consider the dividend payout ratio and the retention ratio, you will find out that dividend payout ratio was almost zero. Now, why that was so? And the firms were selling at a very, very high price. So, isn't it contradictory? The firm is not paying any dividend, but still the prices are rising. This rise in price reflects the investors' confidence in them. So, investors have enough faith in them. Those are good firms. So, that is why they are creating a demand for that. And it was if you consider it now, you might say that okay, that might be a result of speculation. Yes, there were speculations, and that is why we got the, or rather we faced the internet bubble crash. But uh, not all the firms were bad in that IT category, right? So dividend payout was zero, but the firms were being highly valued in the stock market. So how could you relate these two apparently contradictory results? This is not at all contradictory. Now dividend payout ratio is zero. If that is associated with 100% retained earning, then of course the firm has growth opportunity. And since we all go by perception, because the students will always have some perceptions about the teacher, what questions they are likely to set in the exam. So there are certain perceptions about different teachers. So whenever a student goes for opting for a special paper, he or she is always interested to know who is going to teach that paper. So this is the story of perception. So we have a perception about some individual, but the perception may not actually meet with the reality. So that is the point. So if the actual is good in terms of perception, then you are saved. But if the actual is not that good in terms of perception, then of course your money is gone. And if you are a student, then of course your marks are gone. And if you are an investor, then your money is gone. Okay, so that is how we can relate the dividend or the retained earning to the investor's perception. Now, from here, as I have told you earlier, the other line of conflict will also be visible. What is the other line of conflict of interest? We said that there is a conflict of interest between the equity holders and the debt holders. Now, see from here, the interest expenses are first subtracted from EBIT, and then it is taxed, and then if anything is remaining in the form of net profit, then it is going to the shareholders. So if there had been no debt holders, then interest expenses should have been zero, so that if anything is left as net profit, that will be going to the dividend, right? So if the had there been no debt holders, so more will be accrued to the shareholders, and this problem is actually will be more serious during the periods of crisis, because in that case this EBIT will be very low. EBIT is low, but the interest expenses are fixed, right? So you cannot reduce or you cannot defer your interest payment. So you can have a complete or a partial bankruptcy, so that whatever be the type of bankruptcy, the dividend is not going to accrue to the shareholders, right? So from here, it is clear how the two conflicts of interest will actually arise for the firm. The first arises from here, the conflict of interest between the owner and the manager, and the second conflict of interest is between the debt holder and the equity holder. Now, there are many other recent works on which actually you can, if you have interest, you can also go for that. There is a debate actually that who should be rather emphasized, the stakeholders or the stockholders, right? So if the stockholders are emphasized, if the interest of the stockholders are emphasized, then actually we are not talking about the responsible, so-called socially responsible investment. And if we are talking about all the stakeholders, not only the shareholders, so then we are talking about the socially responsible investment. So that is why nowadays the green investment is the call of the day. If you just go through the recent IMF blogs, you will find that the recent meetings, in the recent meetings, it has been emphasized that when we shall be emerging out of this pandemic situation, there will be the need to go for a resilient world. Therefore, we should go for, or rather we should accelerate the green investment. Therefore, the green farms. Now, what is a green farm? A farm which is opting for the green technologies, green processes of production should be emphasized more, and as a result, their prices will be significantly higher in the stock market. And this is the point that we are seeing here in real life. Okay, so I shall be coming to that later on. Now, before we move on to the ratio analysis, is there any question? Let me see the chat box. Okay, so Shaurish has a question. Is there any depreciation on inventory or fixed asset? Usually fixed asset. And Biplov has a question. What comes under other income? Okay. Okay, Shoma has already given answer to that question. Depreciation changed only on tangible fixed asset. Yes. Shaurish, so you have already got the answer. What comes under other income? So it may be any other income that is coming from the activities which is different from the sales activities. So it will be vary from farm to farm. Okay, so in the revenue, we are talking about only the sales activities, and anything other activity which is generating income will be coming under any other income. Okay. Okay, so I think no other questions. So yes.
Hello, ma'am.
Yes.
Yes, ma'am. I want to ask. You said that the small firms, they may not have access to external financing, so they tend to
Yes.
retain part of their earnings. So can you
Yeah.
explain this part a little bit more?
Okay. Okay. And what is your name?
Sharthak.
Okay, Shatu. Right. So this is actually coming from the macroeconomic theory of investment demand. So Shatu, could you please mute yourself?
Yes, yes, ma'am.
Okay, okay, okay. So this is actually coming from the theory of investment demand. There are some studies on that also. I can give you the reference also, but right now, okay, I'll be giving the reference to you also. There has been some empirical research on that the size of the farm will be depending on okay, there was a paper by Fazari, Hubbard, and Peterson. If you are interested, I can give you the paper also. I can give you the link actually. So often there is a credit rationing. So the credit rationing is often more binding for the smaller firms. Now it may not be the case also, right? But I'm saying that often the credit rationing may be maybe more binding for the smaller firms, because the larger firms have greater reputation, but of course that reputation is once again a perceived reputation. So even if, as I have told you, even if it is based on higher credit rating, situations might arise that it is defaulting on its loan. So if the small firms are finding the credit rationing to be more binding, particularly during the period of crisis, then what they should do, they will have to expand themselves. So if external financing is not available for them, they will have to arrange for their own money. So from where they will be getting their funds? They cannot go for further stock, further share selling or any kind of, they are not getting the loan further, they cannot go for any kind of share issuing. So they will be more commonly depending on the amount of profit that is not being distributed as dividend. Therefore, they will decide not to pay dividend. So whatever they are earning after the taxation or anything like that, whatever they are earning, so they will be retaining that with them. So during the period of more crisis or during the periods of expansion, they will be using that, right? So that is how the investment demand theory sets up a link between the size and the retained earning. Okay, but that may not always be true. That may not always be true. I'm saying that. So as an investor, you should be very, very careful. So it is not always true that only the small firms will be going for retained earning, 100% retained earning. Now, see, this result was actually, this paper that I'm talking about is actually a paper written during the pre-IT revolution period, right? And after the IT revolution period, we have number of new economy stocks, the knowledge-based stocks in the economy. So that is why, and once you have the knowledge-based stocks in the economy, the entire system of evaluating and the perception generation, all these things are changing, right? So we are relying more on those phases, those four most dangerous ones. This time it's different. So whenever there is a bubble, we are just saying that, okay, this is not a bubble, this time it's different. So it's a productivity that is going to explain it. So it's not a bubble, the prices are high just because they have growth opportunity. And where lies the growth opportunity? If you ask that question, you will be getting the answer. It may not be the actual growth opportunity, but don't you see that there will be enough perceived growth opportunity? Suppose you don't see any perceived growth opportunity, you are rational enough, but still there will be some other momentum investors who will be having faith on those words, so they will be going for the thing. So now many other firms will be having a higher retained earning, maybe 100%. So you should be very careful whenever you are making any conclusion about the firm. Okay, firm's asset. any other clarification, Sarthak, or is it
No,
clear?
ma'am. Thank you. Ma'am,
Okay.
it will be very helpful if you can share the link for the paper. I will look into it later.
Okay. 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 And but as I have told you, it's not a very new paper, right? Because the result actually may not be relevant for today's world, given the nature of today's fund. Okay.
Okay.
Okay. So now we are moving on to the ratio analysis. So now here we are identifying 5 areas of company health. Now, once again, I am saying that if you just go through any book of corporate finance, you will be finding out all these 5 areas. There are different indicators. What happens if this ratio is greater than 1? What happens if this ratio is less than 1? But that is not sufficient. So you will have to explain or analyze the movements in all these ratios, and you will have to link up all these ratios together. So as I am emphasizing, I'll be emphasizing it later on also, all these areas will be necessary to look into. All indicators will be necessary to look into, but none of these indicators will be sufficient. So just by looking at one indicator, you cannot conclude anything. If you do that, you will be myopic or short-sighted. Okay. So now let us consider the 5 areas of company health. Now, before we move on to that, let us just recall one of the very important result of the macroeconomics or financial economics also, which is the finance growth nexus, or the real sector financial sector interdependence. Now, that is a very crucial interdependence relationship that an investor should take into account. Now, I am just assuming that all those who are doing this class will be rational investor or risk avert investor. So if you are a speculator, then of course these things will not be of any relevance to you. So speculators will be having some other criteria to consider. So this class is not actually meant for the speculators. So this is for the rational investors. Okay. So now, if we consider the finance growth nexus, then in a very simple word, what does that mean? Now, in an economy, there are 2 different sectors. The real sector, which gives us the idea about the real economic activities of firms, and parallelly, there is the financial sector. Now, what is the relationship between these 2 sectors? If you consider the literature, then you will find that broadly there are 3 strands of literature. One strand of literature says that these 2 sectors are not at all related to each other. So real sector is different and the financial sector is different, and these 2 sectors are completely dissociated with one another. Now, this was, of course, a very traditional view or a very old view. Now, if you just consider today's world, the interdependence among the financial markets, the nature of the different crises, particularly the 2007-8 crisis and the recent pandemic also, nobody will be saying that these 2 sectors are not associated with one another. There is clearly a very, very close link. Now, if there is a link, is there any causality relationship? So, is there any lead lag relationship? So, is it the case that the real sector leads and the financial sector lags? So, if you have growth in the economy, or if the real economic fundamental is really, really good, then the financial sectors will automatically be developed in an economy. Or the reverse is just the truth. Therefore, in this trend of literature, we get 2 subtypes actually. One says that a minimum amount of financial development is necessary for the real economy to develop. So it is the financial sector that leads and the real economy will be following. There is another strand of literature which says that finance is just a sideshow of growth. So let the economy grow, then the financial sector will automatically develop. But given, once again, the financial crisis, the waves of financial crisis that world economy has experienced over the recent years, then it is very difficult to concede, or it is very difficult to agree with this type of a proposition. So there is definitely a relationship between the financial sector and the real sector. So there lies the third strand of literature, which shows that there is a bi-way causality. There is a two-way causality between the real sector and the financial sector. So if the real sector is doing good, the financial sector will be doing good, and vice versa. And the reverse is also true. And probably this explains the financial crisis and its impact on the adverse impact on the real economies. So in this trend of literature, we get concepts like contagion, volatility, spillover, so that if one market is volatile or if it is doing bad, then it will spill over to the other markets, other financial markets. Maybe that will be affecting the real sector, right? So these two sectors will be having a bi-way causality. Now, which causality link is more stronger, that will vary from period to period and from country to country. Okay. So whenever you are talking about the ratio analysis, you will find the same thing also. It is a reflection of the same thing. So it is not like the different ratios, defining different ratios and whether its value is greater than 1 or less than 1. It is not like that. So here we are trying to find out whether, as a rational investor, whether the assets performances, financial performances are backed by the fundamentals. So if that link is there, then it is good to invest in those assets. So these are fairly priced, perhaps. Now, in this context, we may distinguish between fairly priced and not fairly priced. Fairly priced assets are simply those where prices, market prices or the stock prices, will be exactly reflecting the fundamentals. So the fundamental models, there are certain fundamental models which will be giving you the fundamental price or the fair price of an asset. So if it is fairly priced, then the market price will be exactly equal to the fair price, but it is very difficult, if not impossible, to find out an asset which is fundamentally priced. So either it is overpriced or it is underpriced. What happens if it is overpriced? So the prices are more than the fair price. So prices are more than what the fundamentals would suggest. So in that case, the asset is not fairly priced, and as a rational investor, it is not wise to invest in those assets. Now, what about the underpriced? Don't say that if it is not fairly priced, I am a rational investor, I am not going to invest in that asset. Now, it is not fairly priced means in that category, you have undervalued assets also. That is not fairly priced. But undervalued assets means that the price, market price of the asset is less than what the fundamentals could suggest. So the fundamentals suggest that the price could be higher, but the market assumes that the prices are lower. So that the market has failed to properly estimate the true potential of this particular asset. So now the prices are lower, and it is a market where complete information is there, therefore ultimately prices will rise. So as a rational investor, right now you can go for investing in that particular asset. Now, speculators will never be interested in these assets because the market price is lower, so they will not be interested in these assets, right? Because they are not interested in fair price or something like that. But if you are talking about the overpriced securities or overpriced assets, then the market has overestimated the true potential of that particular asset. Therefore, the market will soon realize its fault, and then the prices will be, or the perception about the prices will be revised downward. So the speculators will be interested in these stocks, but as I have mentioned in our last session, there will be some revision. If the trigger price is breached, then everybody will try to sell off their assets, and then there will be a panic and a resulting crisis. Okay, so in this ratio analysis, we shall be considering the indicators that are based on the fundamentals and the indicators that are based on the financial performances, and then we shall try to link these two together, these two areas together, right? And then we shall be taking the decision. Of course, we shall be talking about the market prices because that will be coming under the market valuation. So let us now consider what are the different areas of company health. So these are the 5 important areas. The first important area is called the short-term solvency. So what is meant by solvency? Whether a firm is able to meet its financial obligations or not. And why it is called a short-term solvency? This is because whether the firm is able to meet its obligations in the short term. Now, why is short term so important? In the macroeconomics, it is often said that in the long term, in the long run, we are all dead. Of course, it's true. So, different investors are, sorry, many of the investors are myopic in nature. So, they depend too much on the short term measures. I'm not saying that it's bad. It may be good until and unless it is not generating any speculating activity. But if you rely too much on the short-term dynamics of the market, then probably you are contributing to create a panic in the market. Okay. So in the short-term solvency, we are trying to find out whether the firm is liquid enough in the short run so as to meet its current obligations. Right. So, depending on the short-term solvency will essentially mean that you are a myopic investor. So, if you just rely too much on it, forget about other things, then of course your decision may not be true. Okay. Then, so along with the short-term solvency, you should talk about the long-term solvency also. Now, what is long-term solvency? The long-term solvency is based on the financial leverage. Now, what is the financial leverage? Financial leverage is the extent to which a firm relies on debt financing. So, as we were mentioning that, or as we understand, more financial leverage means more debt. So if your earning is fluctuating wildly, then having a higher financial leverage may be risky for you. But if your earning is stable, then a higher financial leverage may be sustainable. So just by looking at the financial leverage ratio, you say that, okay, it's too high, I'm not going to invest in that particular stock. Don't do that. The higher financial ratio may be sustainable. But of course, you will have to consider you will have to analyze it very minutely because there will be recession. So what happens during the recession? If the recession affects the particular firm more significantly, then of course, higher financial leverage will be deadly for this particular firm. Now, if you talk about the crisis also, the crisis will not affect all the firms similarly. So if it is, for example, the IT bubble crash, actually, the IT internet bubble crash, that affected the IT sector, right? But the other old economy sectors were not that much affected. Okay, but there were certain old economy firms that were relying on these knowledge-based firms for some services. So they were, to some extent, they were also affected. So their earning fell significantly also. So a crisis may not always have a tremendous impact on the financial leverage. So just by looking at the higher debt ratio, do not jump into the conclusion that the firm is bad. Okay, so you will have to have other indicators also. So we have short-term solvency, and then along with that, long-term solvency. So we are moving from a short-sighted investor to a more future-oriented or a rational investor, more rational investor. Okay. Now the third area, the activity or the efficiency or the management. So this gives some idea about how efficient the firm is in managing its assets. A firm will be having its assets, so it has purchased different assets, it has raised money for that, but after that, suppose the investments are not that good, so that the assets are not generating enough revenue, enough profit, so that the assets are not managed efficiently. So that is also very, very important for the firm, right? So that is also a very important indicator. Now the fourth one, which is more or less obvious, that is the profitability ratio. So if the firm is profitable, then the investors may be interested in that. So once again, we shall be distinguishing between the actual profit and the perceived profit. What is actual profit? Actual profit, so far as I understand it, actual profit is based on the actual performances of the firm, right? Now, perceived profit is, of course, read from all these financial statements, but it will give us some of the idea about the firm's future profit potential. Now, this future profit potential may not materialize. So, how do you consider that? Suppose in 2018, you find that the firm has enough investment opportunity, right? So it is retaining earning, it has profit, but it is not paying out dividend. The other indicators are doing well. Now, see what happens in the 2019. Has the profit increased? So that is one very simple way to look at it. So you should consider in terms of lags also, right? So whether the 2000, whether the potentials in period T are going to materialize in period T plus 1, that is our perception, and whether in period T is actually materialized in period T plus 1. If that is actually materialized, then that firm is a good one, right? Now, suppose you cannot focus, then what should you do then? You just back calculate. Consider 2007. So if 2007 to 18, if the potentials are realized, then you may have a probability, not exactly equal to 1, that the firm will be meeting its expectations in the next year also, right? So in that way, we have the first 4 areas. Now, so far as I understand, these first 4 areas will be somehow related to the firm's real activity. So these are based on the capital structure. Now, although it is taken from or appropriated from the financial statement analysis, but these things are dependent on the firm's actual economic activity, right? So it doesn't have any financial market in it, right? Valuation in the financial market. So now I shall be separating these two areas, the valuation in the financial market and the other things that are depending on the activities of the firm. And if these two match, then of course you have some merit in investing in that particular asset. So now comes the fifth area, the value. So that gives us the market valuation. So how does the stock market? So we shall be considering only one financial market here. There are so many other financial markets, but we are not talking about that. We are considering only the stock market as the financial market here. We are not talking about the foreign exchange exposure or any other things. So it is just the stock market. Okay. And of course, here I'll be talking about only the domestic stock market, but you can relate it to the global stock market movements also, but that is not within the purview of financial ratios, but you can consider the global market movements also. So these are the 5 areas, and now we shall try to define some of the major indicators. I'll be only defining, and whether the higher the ratio is good or lower the ratio is good, we shall be going into only those things, right? And then we shall be using the data to find out the investment potential of a particular firm. Okay, now just okay, let me finish it off first, then I'll be giving you some, I'll share with you some data, so that probably today is the second day. So probably I'll be sharing those data with you on tomorrow. So you just have a look into that, and you just try to comment on the investment potential of that particular firm. Now, there is an obvious question. If you want to comment on the investment potential of a firm, there should be other firms in the group also, because everything is relative, right? So nothing is absolute. So you are saying that, okay, Maruti is doing good in terms of what? Who are the peers in terms of the other automobile stocks, or in terms of other stocks also, in terms of the general market also? So you must have some other companies. Okay, so in that case, I'll be sharing with you 2 company data, and you just try to find out, or rather you just try to comment on your investment plan. Which one will you prefer? If you are interested, I can share more than 2 also. Okay, so just let me know after the class. Okay, so now we are moving on to the short-term solvency or the liquidity ratio. So I have already discussed the areas and the relevance of the areas. So here I shall be just defining the ratios and the implication of having a higher ratio or a lower ratio. So I'll be considering only the very important ratios in this section. Now, if you just go into the literature, then you will find that there are lots of ratios. In fact, there is a book by, I'll be giving that you as a reference. There is a book called Financial Statement Analysis by Wild et al. So that is a very good book, and this book is entirely based on the financial statement analysis, the planning based on the financial statements. In this section, actually, in the sessions, actually, I'll not be able to discuss the plannings using the financial ratios, but I'll show you one thing, whether the firm is requiring the external financing or not, the sustainable growth rates. I'll be talking those things, but since it's a class on the financial ratio, so I'll not be going into break-even analysis or scenario analysis or sensitivity analysis, but those are really good things to use when you are taking the investment decision. Okay, so now we are moving on to the short-term solvency or the liquidity ratio, where we have here, I am mentioning only 4 ratios. Now there may be many others, but these 2 will be sufficient for our purpose. So the short-term liquidity. So whether the firm is able to meet its short-term obligations. We start with the net working capital. So if you just go back to the balance sheet. Okay, so I have discussed that this is the total current asset. So that gives us the assets in the short run, and this is the current liability. So the obligations that you will have to meet in the short term. Therefore, the idea is whether you have or the firm has enough money in the short term so as to meet this short-term liability. So whether this short-term asset is enough to meet this short-term liability. So that is the idea. On the basis of that, we shall be defining different indicators. Okay. The first one, the net working capital. So this is a widely used concept. So that gives us the difference between the current asset and the current liability. So if this is exactly equal to 0, so what does that mean? That means that the current asset is exactly sufficient to maintain the current obligations. And if it is greater than 0, then current assets are greater than current liability. So you are better off in the short term. But we are not saying that you will be better off in the long term also. So for that, you will have to consider the other indicators. So that actually shows why all these indicators are necessary. So you should consider the short-term solvency, because if you are so rational that you will be thinking in terms of long term only, you are not at all interested in the short term. Whatever happens in the short term, you will always be sticking to the asset. But in the short term also, there will be different variations. So you should have some idea about all these things. Suppose that the firm over a period of time is not performing well in terms of short-term liquidity ratios, then why should you stick to that firm? So it is just not a one-time matter. Just for look at the balance sheet, look at the financial ratios, you are finding it to be greater than 1, so it's good. Absolutely meaningless. So you will have to analyze the entire trend. I'll show you how to find out the trend. Probably I'll be showing you a filter process from where you can find out the filter. If it is possible, I'll be showing you. I'm working on it. But for that, I'll be requiring more data, right? So I have data for 15 years. I'll try to find out whether the filtering is possible or not. If possible, I'll be showing you that, the long-term trend. Okay. So the net working capital. So I have the better. Next comes the current ratio. So it is just another variation of the net working capital. So current ratio is just the current asset by current liability. So current asset in proportion to current liability equal to 1. So you are just solvent. Greater than 1, you are solvent, right? And less than 1, you may not invest. Now that's up to you whether you will be investing or not. Then comes the quick ratio or the asset test ratio. Now, whenever you are talking in terms of the asset, be it current asset, be it total asset, be very, very careful while you are comparing the firms, right? So just by looking at, suppose I have given you a balance sheet for a service provider and a IT firm, and the balance sheet for a hardcore old economy firm. And you say that, okay, current ratio is greater for the old economy firm and it is less for the new economy firm. Therefore, I am going for the old economy firm. Now, is there any problem in that decision? Now, after all, it's your money. So if you are interested, you can go for that. But there are certain problems, because I'm just going back to current asset, definition of current asset. So here lies one important thing, which is inventory. Now, some firms may not have inventory, or by nature, they cannot have inventory. So just by looking at the current ratio, just by comparing in terms of the current ratio, you will be doing a mistake, because the current ratios may not be comparable at all. First of all, current ratios may not be comparable. So just by having a higher current ratio, it means nothing. Okay? So that is why we need a more comprehensive ratio. So that is why we come to the quick ratio. Now, quick ratio, by definition, treats current asset in a more different way. So it assumes that inventory should be subtracted from the current asset. Right? Why it should be done? Because these ratios are the liquidity ratios, short-term liquidity ratios. So you should consider the most liquid assets in your total category of asset. But in the current asset, you have the inventories that is not that liquid. Therefore, in order to compare the true liquidity positions, you should depend on the quick ratio, which is called the acid test ratio. So suppose your cash equivalent, these are all very low, but you have accumulated your inventories. So that may be once again due to many reasons. Suppose there is no demand, or you are trying to prevent your competitors from entering the industry. There may be many reasons, but you have accumulated inventory, so that will be giving your current asset to be a high value. So in that case, you should go for a quick ratio, and that is why the name suggests it is an asset test ratio. It is called an acid test ratio. So it is more liquid form of liquidity ratio. And if you consider the quick ratios, then you can actually compare firms of different types. So inventory, whether inventory is there or not, that doesn't matter. So you can always compare a firm that by nature doesn't have any inventory and a firm that has inventory. So you can compare that in terms of the quick ratio, but not in terms of the current ratio. So whenever you are choosing the ratio, you should be very, very careful. Okay, and then the cash ratio. So the cash by current liability. So this is often used by many short-term investors. So it is the amount of cash. So cash is the most liquid item. So that is why we will be interested in the cash ratio. So these are the liquidity ratio that we shall be considering in our analysis. Next, we come to the long-term solvency ratio, or the financial leverage ratio. Now here, the total debt, we start from the debt ratio or the total debt ratio. Usually called it a debt ratio, debt to asset ratio. Now this is total debt by total asset. So here total debt is represented as total asset minus total equity. So from the balance sheet, asset is equal to liability plus equity. So you have the total debt. So ideally, this total debt is current liability as well as long-term liability. So total debt. Okay. So total debt by total asset. Lower the better, because more debt will be meaning more financial leverage and more interest payment, higher possibility of bankruptcy. But once again, things are not that easy. First of all, as I have mentioned earlier, suppose a firm has higher financial leverage, but at the same time, it has enough cash flow, enough earning to meet this obligation. Therefore, just by looking at this, it would not be that wise to comment on the firm's investment potential. So just don't jump into conclusion on the basis of any single ratio. So if the debt ratio is high, consider the other ratios. So if the other ratios are favorable, then you can go for it. But if at the same time the debt ratios are rising, the profits are falling, and the other activity ratios are not that good, then you may not go into that particular asset. Now, once again, I'm saying that you may not go because it's your money, it's your understanding, it's your analysis. Now, your analysis may be different from my analysis. All right. So, in my classes, actually, I always give the data to my students, and they just try to comment on the investment potential of the firm. And if we have 20, 25 students, then in each case, there may be different results. And that result may or may not be matching with my result. So after all, we are all rational individuals, and in the context of financial economics, we do not talk about, or rather we talk about rationality in a special sense. We are all rational, but you are not all rational in the same sense. We all have our own rationality while defending our investment decision or while taking our investment decision. Therefore, if we assume that all the individuals are identical, therefore all the investment decisions will be same, identical for all the individuals. Because why? The balance sheet is giving this, the profit and loss account is giving this, the ratio is greater than 1, then go for this ratio, then go for this one. It's not that. So all the individuals will be rational in their own way. Speculators are also rational, but they are rational in their own way. Their utility function is different. They get satisfaction from some different thing, right? Somebody may be getting fun from making witty comments, and somebody may be getting fun from sarcasm. So that's the difference, right? So it is not rationality as such, it is bounded rationality. So that is why our trigger prices will be different for different individual. Otherwise, we all would be having the same trigger price. Why it is the case that when somebody is selling the price of share of Infosys, others are sitting tight with the same share? Why it is the case that somebody is not going to buy the share of Infosys, but is going to buy the share of Polaris Software? I don't think that you have heard the name of Polaris Software. It was there in the period of 2000, 2001, but in that period, it was a highly valued firm, but it didn't have that profit potential, right? So how do you explain that? Now that can be explained if we treat each individual separately. So whenever decisions are taken, just don't assume that every decision will be fit for all. So each will be having his or her own portfolio. So it is not rationality in the traditional sense, but rather it's a rationality in some other sense. Okay. So that is why the ratios should be analyzed in a different way than what it is suggested in the accounting literature or in any other literature. So it's your money. Try to define it in your own way and try to defend your investment policy. Okay. So debt ratio, that is one point. So higher debt ratio may not be a very bad thing as long as you have money. Now, this debt ratio, once again, is based on total asset. Now, if you are taking decision on the basis of the total asset, then once again, be very, very careful in taking any decision. Because if you, once again, go back to the balance sheet, then what happens? In the total asset, you have the current asset as well as the fixed asset. In the fixed asset, you have property, plant, equipment, right? So it may be the case that there are certain certain firms for which the total asset may not include the fixed asset. think about the service provider. They will be having their amount of fixed asset will not be that great as the amount of fixed asset of the other old economy firms. So whenever you are thinking in terms of the total asset, then try to have a look into the components of the asset, nature of the firm. That is very important. So suppose there are two firms from the two completely different sectors. So one by nature will be having relatively lesser amount of fixed asset. By nature, it cannot have a large amount of fixed asset, but the current assets are the same. But compare it with the old economy, say heavy manufacturing firm, so it will be by nature having a higher fixed asset. So the total asset for the heavy manufacturing firm will be much greater than this particular firm. So given the same amount of debt, there will be a difference in the total debt ratios, right? So since the denominator is higher, the old economy firms will be having a lower debt ratio. So is it good? Maybe or may not be. Maybe. I'm not saying that the old economy firms are having lower debt ratio, so that is not bad, that is not good. So it may be or may not be. There are so many other things to consider. So whenever you are thinking in terms of the total assets, so be very careful. Okay. So now the next one, the debt equity ratio. The debt equity ratio, so we have very little time left for today. I'll try to complete this financial leverage ratio. So the debt equity ratio, it is nothing but, okay, the debt ratio will be taking a value from 0 to 1. It cannot be 1. Because if it is 1, then total debt is equal to total assets, so that the firm is completely debt financed. So usually it is not 1. Once again, I'm making an understatement. So it is not equal to 1. Okay, the total debt equity ratio. So it is simple. Total debt by total equity. So higher the ratio, more financial leverage compared to the equity. So the firm may be in distress, particularly during the periods of economic distress. So once again, you should be very careful. The next one is the equity multiplier, which is the total asset by total equity. Therefore, in the first two cases, we were talking in terms of debt asset and debt equity. So now we are talking in terms of the equity, the total stockholders' equity. So total asset per unit of total equity. So it means actually how profitable or how remunerative the stockholders' equity is. So better the remunerative capacity of equity, the good will be the solvency of the firm. The fourth one, times interest earned ratio. So this is EBIT by interest. EBIT is earning before interest and taxes. So out of that, interest is paid. First interest is paid and then taxes are paid. Now why it should be an indicator of the long-term solvency? Because it is the EBIT out of which interest is paid. So if EBIT per unit of interest is lower, then there is a problem, right? And if EBIT is equal to interest payment, then what happens? The entire amount of EBIT is going to pay the interest payment. So that may be, I don't know, I think that as a bad thing, because nothing will be left for the equity holders, and out of which, and of course there will be zero taxable income also, because everything has been paid out as interest, right? So the firm has generated earning only just enough to meet its interest payment. And the last one in this category is called the cash coverage ratio. So the cash coverage ratio is given as the EBIT, earning before interest and taxes, And then the depreciation, we add back the depreciation and the amortization, right? So depreciation, it's the amount spent in order to meet the wear and tear of your asset, and amortization means your debts have retired, so you are paying back the principal amount, right? So this cash coverage ratio considers not only the EBIT plus the other cash items that the firm had in hand. So it was depreciation. Firm initially had it in its hand, but it has paid it out. And amortization, of course, now it is going to the debt holders, but initially it was with the firm. So therefore, we are expanding the capacity of the firm a little bit. So instead of just considering EBIT, we are incorporating some other cash items into it also, so that depreciation and amortization will also be introduced there. Okay, so these are the two major areas that we have considered. We have only 5 minutes left today, so that is why I'll not be going into the asset management or efficiency measures, because we still have 2 days to go. So now I'll rather ask you for any clarification or any questions that you have. So let's see whether anything is there in the chat box. Okay, Jishan, can you give references of estimation of depreciation method? Of course, I'll be giving you, but it is not, since it is not a part of this, it is not within the purview of this session. You just give me a mail, send me a mail, I'll be giving you the references, okay? And Priyanka, you have a question, ma'am, what is the meaning of knowledge-based stock? Now, knowledge-based stocks, these are the new economy stocks. So the stocks are named according to the type of firms they represent. Now, there are certain knowledge-based firms. So what are the knowledge-based firms? The firms that are basically called ICT, information, communication technology, media, etc. So all these firms use knowledge, right, as one of the most important factors in their production function. So they use knowledge to produce something. So these firms are knowledge-based firms. But consider the other firms, for example, say heavy electrical firms, manufacturing firms, paper firms, anything else, consumer durable. So they are called the old economy firms, or they are not the knowledge-based firms as such, because they may use knowledge, but they are not providing any kind of software service or communication related service. So knowledge may be a part of their production process as a factor, but it has got relatively less or no significance, right? And the stocks of those knowledge-based firms are called the knowledge-based stocks or the new economy stocks. Some biotechnology firms also, they are depending heavily on the research and development. So in that case, these stocks are also called knowledge-based stocks. The biotechnology or any kind of firm that is based on research and development and that provide any kind of service. So these are called knowledge-based service. So these are called knowledge firms. So Priyanka, is that clear to you? Shomik has a question. Shomik wants to know the equity multiplier. Once again explained. Okay, I'm coming to that. Parthasharathi Roy, can we do a valuation of a knowledge-based asset? Once again, it's a very difficult issue, because for the knowledge-based firm, now my research, PhD research, MPhil and PhD research was based on IT revolution and evaluation of IT stocks. Now there, the problem was that the fundamentals, the so-called asset valuation theories, do not hold for the IT, for the knowledge-based stocks. Their prices usually do not reflect the fundamentals. So that makes the valuation very, very difficult, because often these knowledge-based stocks will be having higher price just because of the fact that they have perceived growth opportunity. So perceived growth opportunity means people, okay, Priyanka, I am just giving you the example of knowledge-based stocks. Yes, e-learning, IT, I have already given you the examples of knowledge-based stocks. It's information, communication, technology, media firms, etc. Okay, so I'm just coming back to the question raised by Parthasarathi. So that makes it very, very difficult. And so far as we are getting the same thing, so far as the green stocks are concerned, the valuation is really, really very difficult. So for that, often we find that these stock prices are characterized by the chaotic dynamics, where the valuation of the volatility is generated endogenously from within the system. The exogenous volatility has nothing to do with the prices and the price formation mechanism. So once you have the volatility endogenous to the system, then the policies, the fundamentals will not be working satisfactorily. So that is a problem. So you will have to identify some other ways. You may estimate the you may estimate the perceived growth opportunities. So, and you can use that as one of the variables affecting the stock prices. So given the standard asset theory, it is very difficult to evaluate. Okay, so Parthasarathi, does that clarify? Okay. So any other question then? So any other question, any other clarification? And of course, if you have some question, you can always mail it to me, and I'll be giving the answers. I'll give you the references as well as the name of the sites probably tomorrow, because I think by tomorrow I'll be finishing off with all the discussions about the ratios and the analysis. Then probably in the next half of the the third day and the fourth day also, I shall be doing something on the practical things. Okay, so Shomik has a question. Debt equity ratio. Total debt means current liability plus long-term liability, right? Total debt plus total equity. Total debt by total equity. And total debt will always mean that total short-term debt plus long-term debt. And in some cases, you have long-term debt equity ratio, but if it is long-term debt equity ratio, then it will be specifically mentioned which type of ratio it is. Yeah, of course. Sharthak has a very interesting question. Do the financial ratios change with the age of the firm? Any link between the? Yes, of course. Of course. So that is why you will have to consider the trend. But I just right now I cannot tell you which is the direction of the link. So whether with age the financial ratios move in the adverse direction or whether they move in the favorable direction, so there is no as such general rule with that. So you will have to do it on a case-to-case basis. So that could be a very good. Okay, so equity multiplier, I have not explained that. Okay, so Shomika, I'm just giving answer to your question. So of course, so far as the question raised by Sarthak goes, yeah, of course, so that could be a very good research topic. So you just consider the age of the firms, or many other, suppose some important policies taken by the firm. Then what happens after the policies are taken by the firms? What happens to the financial ratios? So anything is possible. Financial ratios may improve or it may deteriorate. Okay, Shomik is raising a question, so let's try to answer it. So equity multiplier. Equity multiplier is total asset by total equity. So in the context of debt ratio or debt equity ratio, we are talking in terms of total debt, total asset, total debt, and total equity. But in the context of equity multiplier, we are talking in terms of the equity, not in terms of the debt. So total asset per unit of total equity. So in one way, it measures the efficiency of the equity, right? So equity holders are more interested in the equity multiplier. Now, suppose you have the all equity financed firm. So maybe it's a venture capital financed firm. So in that case, total asset will be equal to total equity. So it will be equal to 1 exactly, right? But if you have a mixed capital structure, so that the firm is having some financial leverage, so in that case, your total asset will be different from total equity, and total asset per unit of total equity is an indicator of financial leverage. So just without considering the debt, we are considering from the point of view of the equity holders. Okay, anything else? Okay, so if there is no clarification required further, so we can leave now. So once again, we shall be meeting tomorrow. And so far as the assignment goes, I'll be discussing that on the 4th day. So let me first do the analysis part, and then I'll be talking about the assignment. Okay. And in the meantime, as I am mentioning, that if you have any other question to raise, so right now you are not being able to raise that question, or it is not coming to your mind, I'll be available on mail. So just drop me a mail. I'll try to answer. Okay, so if there is no other question, then we will leave. Okay, so bye for today.